The first principle emphasized by Robert Kiyosaki is the power of financial education. According to Kiyosaki, one of the reasons many individuals struggle financially is because they lack the necessary knowledge about money and investing. He believes that traditional education often fails to teach us how to manage our finances effectively. Kiyosaki suggests that we should strive to become financially literate by seeking out information and learning from those who have achieved financial success. Many famous investors such as Warren Buffett, Charlie Munger, and Ray Dalio emphasize the importance of continuous learning and expanding your financial knowledge. Warren Buffett, known as the Oracle of Omaha, is famous for his dedication to reading and acquiring knowledge about businesses and investing. For example, Warren Buffett's recommended reading list includes books like The Intelligent Investor by Benjamin Graham and Common Stocks and Uncommon Profits by Philip Fisher. These books provide valuable insights into value investing and the importance of understanding a company's fundamentals before making investment decisions. By actively seeking financial education, you can develop the mindset and knowledge needed to make informed investment decisions. Reading books by successful investors like Warren Buffett's The Essays of Warren Buffett or Ray Dalio's Principles can provide valuable insights and lessons that you can apply to your own investment strategy. Additionally, attending investment seminars or workshops, following reputable financial blogs or YouTube channels, and participating in online investment communities can also contribute to your financial education. The more you learn about different investment strategies, asset classes, and economic principles, the better equipped you'll be to navigate the complex world of investing. Remember, financial education is an ongoing process, and you should continuously expand your knowledge to adapt to changing market trends and investment strategies. Moving on to the second principle from Rich Dad's Guide to Investing, the importance of cash flow. Kiyosaki stresses that building cash flow is crucial for long-term financial success. He advocates for focusing on investments that generate positive cash flow, such as rental properties or dividend-paying stocks. Famous investors like Charlie Munger, the longtime business partner of Warren Buffett, also emphasize the significance of cash flow. Munger once said, "The first rule of compounding, never interrupt it unnecessarily. It's wise to keep generating a little cash, even when you're not going to get a good return, by reinvesting everything." This highlights the importance of not only seeking capital appreciation, but also focusing on investments that provide regular income. For example, real estate investor and entrepreneur Grant Cardone built his wealth by investing in income-generating properties. He emphasizes the power of cash flow, stating that it allows you to have control over your financial destiny and create passive income streams. Dividend-paying stocks are another avenue for generating cash flow. Companies that consistently pay dividends provide shareholders with a regular income stream. For instance, Procter & Gamble, one of the largest consumer goods companies, has a history of paying dividends to its shareholders for over 60 years. By investing in dividend-paying stocks, you can potentially receive a steady stream of income while still benefiting from potential capital appreciation. Kiyosaki's principle aligns with the strategies of these successful investors, reinforcing the idea that assets that generate positive cash flow can provide stability, passive income, and financial independence. Our final principle from Rich Dad's Guide to Investing is all about embracing risk and taking control of your financial future. Kiyosaki encourages readers to become proactive investors, rather than relying solely on financial advisors or mutual funds. He believes that taking control of your investments allows you to better understand and manage the risks involved. Famous investors like Peter Lynch, known for his successful tenure at Fidelity Magellan Fund, also advocate for taking control of your investments. Lynch famously said, "Know what you own and know why you own it." He believes that individual investors have an advantage over professional money managers because they have the ability to research and understand individual companies and industries. Taking control of your investments involves conducting thorough research, analyzing financial statements, and understanding the factors that drive the performance of your investments. By doing so, you can make informed decisions based on your own judgment, rather than relying solely on the advice of others. However, it's important to note that embracing risk doesn't mean being reckless. It means being willing to take calculated risks based on your own analysis and understanding of the investment. Conducting proper due diligence, diversifying your portfolio, and managing your risk exposure are crucial aspects of taking control of your investments. By actively participating in the investment process, you can gain valuable experience and potentially achieve higher returns. However, it's essential to exercise caution and remember that investing always carries a degree of risk. Conduct thorough research, seek professional advice when needed, and prepare to adapt to changing market conditions. By taking control of your investments, you can also avoid high fees associated with financial advisors or mutual funds. Kiyosaki suggests that understanding the fees and expenses involved in various investment vehicles is crucial to maximizing your returns. By minimizing unnecessary costs, such as management fees or transaction fees, you can potentially keep more of your investment gains for yourself. Let's take an example to illustrate the impact of fees on your investment returns. Suppose you invest $100,000 in a mutual fund that charges 1% annual management fee. Over a 20-year period, assuming an average annual rate of return of 7%, your investment would grow to approximately $386,968. However, if you had chosen a low-cost index fund with a negligible management fee of 0.01%, your investment would have grown to approximately $452,592 over the same period. By avoiding the higher fees, you would have gained an additional $65,624 in returns. This example highlights the significance of understanding the fees and expenses associated with your investments. By taking control and choosing low-cost investment options, you can potentially increase your overall returns over the long term. Moreover, embracing risk doesn't mean taking unnecessary risks or investing without a plan. It means having a well-thought-out investment strategy that aligns with your financial goals and risk tolerance. This strategy should consider diversification across different asset classes such as stocks, bonds, real estate, or commodities. Diversification is a risk management technique that aims to spread your investments across various assets to reduce the impact of any single investment's performance on your overall portfolio. For example, if you had invested all your money in a single stock that experienced a significant decline, your entire portfolio would be at risk. However, if you had diversified your investments across multiple stocks, bonds, and real estate, the negative impact of one investment would be mitigated by the performance of others. Renowned investor Mark Cuban once said, "Diversification is for idiots. You can't diversify enough to know what you're doing." While Cuban's statement might seem contradictory to the principle of diversification, his point is that you should focus on investments that you thoroughly understand rather than blindly diversifying for the sake of it. It's essential to strike a balance between diversification and having a deep understanding of your investments. In conclusion, the principles outlined in Robert Kiyosaki's Rich Dad's Guide to Investing can serve as valuable guidelines for building wealth and achieving financial independence. By seeking financial education, focusing on cash flow, and taking control of your investments, you can increase your chances of long-term success in the investment world. Remember to continuously expand your financial knowledge, analyze the cash flow potential of your investments, and take calculated risks based on thorough research. Ultimately, by implementing these principles and remaining disciplined in your investment journey, you can work towards realizing your financial goals. And that wraps up our discussion on Robert Kiyosaki's Principles from Rich Dad's Guide to Investing. We've covered the power of financial education, the importance of cash flow, and the significance of embracing risk and taking control of your investments. By applying these principles, you can develop a strong foundation for your investment journey and increase your chances of achieving long-term financial success. Remember that investing is a continuous learning process, and it's essential to stay informed about market trends, economic indicators, and evolving investment strategies. To further reinforce the principles we've discussed, let's take a look at some of the successful investors who have exemplified these principles throughout their careers. One notable investor is Charlie Munger, who alongside Warren Buffett has achieved remarkable success in the investment world. Munger is a strong advocate of continuous learning and has emphasized the importance of expanding one's knowledge in multiple fields. His multidisciplinary approach to investing has played a significant role in his investment success. Another prominent investor is Ray Dalio, founder of Bridgewater Associates, one of the world's largest hedge funds. Dalio stresses the significance of understanding economic cycles and using them to inform investment decisions. His book, Principles, provides valuable insights into his investment philosophy and the principles that have guided his success. We can't discuss successful investors without mentioning Warren Buffett. Often referred to as the greatest investor of all time, Buffett's dedication to financial education, his focus on cash flow generating investments, and his ability to take control of his investments have been key factors in his remarkable track record. By studying the strategies and philosophies of these legendary investors, you can gain valuable insights and inspiration for your own investment journey. Remember, investing carries risks, and it's crucial to conduct thorough research, diversify your portfolio, and seek professional advice when needed. Be patient, stay disciplined, and focus on the long-term goals you have set for yourself. If you found this video informative, don't forget to give it a thumbs up and subscribe to our channel for more insightful content on investing and personal finance. Also, feel free to leave your comments and questions down below, and we'll be happy to engage with you. Thank you for joining us today, and we look forward to having you with us in our future videos. Happy investing!